Illiquidity premium is the excess return offered to investors when they agree to keep their capital invested for a longer, often set period of time. If you think about it, it makes conceptual sense. When an investor agrees to commit their capital, the investor gives up the option to sell that investment during the locked-up period of time. And so the investor should be rewarded for that. For an investment manager, having the certainty of capital allows that manager to pursue illiquid investment strategies, such as private equity or private credit, that can then generate returns above and beyond what is available in public markets. And this excess return, this illiquidity premium, then flows back to the investor. To be clear, the illiquidity premium is not a set number. It's the excess return that has been historically generated in private markets over their public market counterparts. When analysts try to account for illiquidity premium in their models, the usual assumption is a 3% to 5% excess return over public markets. That is reasonably close to what I've seen from my own historical experience. If you think about it from the inverse perspective, it also means that an investor effectively pays 3% on the low end for the option to redeem their capital on a daily basis. And I think that's not necessarily as intuitive because, again, it's not an actual option that you're buying and paying for. But if investors have capital they want to keep invested for the long term, and they know that they won't need it immediately, retirement assets come to mind, then we believe those investors should be capturing the illiquidity premium. Keeping that capital invested in daily liquidity assets is, in effect, continuously paying for a liquidity option. Now, the challenge has been the lack of opportunities for individual investors to actually take advantage of their long-term capital, and that's one of the challenges that we're solving here at Ivy Invest.